Okay. So here we left off, right? We finished chapter 8. Now we're on chapter 9. So let's go ahead and answer this question. So use the following information to answer the next question. Okay. So that means on January 1st, you establish a petty cash fund for $500. Okay. By January 31st, you counted all of your receipts, and here they are. So here we purchased or we used money to buy a birthday cake. We bought pizza, we bought office supplies, and we bought postage stamps. Okay, so here for $19.99, $23.78, $6, and again for $10.75. So the question here says that, okay, for what amount do you need to write a check for the replenishment of your petty cash fund?
B.
B. Let's see what B is. You need to write it for $60.54. Okay, how did you get that?
I added all the receipts together.
So right now, the box of money, right, in the very beginning of the year, it had $500. And here I'm counting all the receipts. So in this case, in order for my box to stay or to have $500, how much do you need to replenish it for? And the rule here is that we add up our total amount of receipts. So $19.99 plus $23.78 plus $6.02 plus $10.75 should get you, let me see. Yep, so it should be $60.54. Okay, so then when we add back $60.54, then my account balance in my petty cash fund should hold how much cash?
500.
It should add up to 500. Okay, hello? So that's exactly what we're going to do here. So the whole purpose of replenishing the petty cash fund is to essentially put the money back into the petty cash fund. And then at the end of when you make your adjustments, you're going to write off these expenses, okay? And we'll take a look at that next week, okay? So good. All right. Question number 36 says, how do you establish a petty cash fund? A, right? You're going to debit your petty cash and then you're going to credit the checking, right? This is to establish, right? You wouldn't debit checking and then credit petty cash because that just means that you're closing it out, right? We're not adding money back to our bank. We're subtracting money out of our bank, all right? Debit cash funds and all expenses and credit all expenses. Expenses will usually normally never be credited. So this one, you can already see it's already false. Debit all expenses and credit petty cash fund. You never do that under any circumstances. Okay, so A is correct. Right? In order to establish a petty cash fund, you're going to create one and then you're going to add money to it. Okay. Question number 37 asks, how do you replenish a petty cash fund?
B.
B, write a check for the amount of total receipts in the lockbox from the petty cash fund. Yes, so as I mentioned it from the previous question above there, what you're going to most likely take a look at is something similar to question number 35. I will give you an example of a petty cash fund, and I'm going to ask you to replenish it. So this one, if you know how to just add up the receipts, you guys, that's an easy one. That's an easy point that you guys can earn. Okay. All right, chapter 10 now. Question number 38, okay? Under which method does the IRS use to write off bad debt for tax purposes only?
C.
C, right? Direct write-off method, yes. So as we discussed this before, there are two ways to write off bad debt. The direct write-off is used for tax purposes only, okay? Because it directly takes the accounts receivable and it writes it off directly into bad debt expense. Whereas an accountant, we can't do that because one, we haven't reached the end of the year yet, but second of all, we're not the tax accountant. We have to properly use the allowance method, right? To properly place it in a placeholder, exhaust every single means to try to collect the money, and then when we confirm it is ready that we're never going to get our money back, that's where we got to move from the allowance into the bad debt account. So in this case, that is correct. The direct write-off method is the one that we use for tax purposes. Okay. All right, question number 39 says a company estimates that $34,887 of its 500,000 accounts receivables are to be uncollectible. Okay. And there's currently a debit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry would be
B. You'll take the estimate 34,887 and add the 5,000 to give you a total of 39,887.
good. Because which method am I using? The income statement method or the balance sheet method?
It's a balance sheet method, correct?
Correct. Because on the balance sheet, you recognize that there will be an accounts receivable. Okay. So in this case, it would be bad debt, right? Expense. And this will be the allowance for doubtful. And it is going to be for the 39,887. Okay. The indicator here is that we have a debit balance. And our end goal is we need to have a credit balance of $34,887. So in order to get there, you need to backtrack because you already currently have $5,000 in the debit. So you need to add them together. Okay, so 39,887 is correct. Okay. Question number 40. Okay, a company, A company estimates that 34,887,000 of its 500,000 total credit sales is to be uncollectible, and there's currently a credit balance of $5,000 in the allowance for doubtful accounts. What should my entry be? A, 34,887. Okay. So here, which method are we using?
The income statement method.
Income statement method, where you never get to you will never see accounts receivable on there. All you will see is just your total credit sales. So in this case, right? Therefore, our only option is that when we recognize that there is that we have an estimated amount. That's all we care about. We don't care if there's a balance in the allowance for doubtful accounts because it doesn't appear on the income statement. So therefore, the only number that you will use is the estimated number, which is the 34,887. Okay, so correct is A. Okay. Let's complete another one, all right? A company estimates that $34,887 out of its 1,000 accounts receivable are to be uncollectible, okay? And there's currently a credit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
C.
Okay. So in this case, we're recognizing this is the balance sheet method because we recognize that, hey, we have an estimated amount, right? And our indicator is here that if we're using the balance sheet method, which is we recognize the accounts receivable, we see that there is currently a credit balance. Therefore, there's already some amount in the allowance or doubtful accounts that's already in the credit side. So our goal is to get to 34,887 at the end of the day. So in this case, if I already have $5,000 in my credit side, how much more do I need to get to the 34, right? And that answer is you subtract the two numbers to get 29,887. Okay, so there's the indicators are there. All you have to do is just be aware of which method you are using. Okay, and it's for 29,887. Okay, is everyone good so far? Okay, and of course, last but not least, same thing, except this time, right, we have $34,887 of a $500,000 total credit sales, right? There's currently a debit balance of the $5,000 in the allowance for doubtful accounts. So therefore, what is the estimated or what is the adjustment entry going to be?
A.
Okay. Once again, keywords here is total credit sales. Okay. Therefore, that should just give you a flag right there to indicate that we don't care about any balance in the allowance for doubtful accounts. We just care about just the estimated amount, which in this case is $34,887. Okay. So once again, the only way I can describe this to you to be able to be successful in answering the questions is to read the question really carefully, because the key words that we're looking for is the difference is going to be accounts receivable and total credit sales. Okay, so make sure that you read carefully, because I will test you on both. I will test you on all. Maybe I'll test you on all four. Okay, just exactly like this. All right, and you need to determine to me the difference between the different methods, whether you're doing balance sheet or income statement. Okay, and in this case, excellent, it should be just the estimated amount. Okay. Any questions in regards to just this small section in chapter 10, the allowance for doubtful accounts?
Can you go to 41 real quick?
I'm sorry, which one?
41.
41. Okay. On this section here, I will only test you on the bad debt expense. I'm not going to test you on in-betweens where we figure out how you develop a debit or credit balance for the allowance for doubtful accounts. I only want you to know how to write it off.
Okay.
Okay.
Yep.
All right. Now we're going to be moving on to this question here. So it says, use the following tables below to answer the next question. Hold on, let me take a look at this real quick. Okay. Okay, so once again, I provided here a little table, or in this case, I provided you the bank statement. Okay, so it gives you all the details there. I've also provided you the cash ledger, right? So it says our books. I also provided the check register, right? So when every time we write a check, you know exactly who you wrote it out to for what amount. And last but not least, there should also be the deposits ledger as well, or the receipts and deposits section here. Okay. So of course, we're going to be looking at how to do a bank reconciliation. So which side do you want to start on first? The bank side or the cash side?
Let's do bank.
Bank. Okay. All right. So first things first. What's my ending balance in my bank account?
$1,088.
Okay, so we have $1,088. So the next thing we got to solve for is what am I going to be adding to my bank?
Deposits.
Deposits, okay? So let's take a look at our deposits. How many deposits on our books do we have?
5.
We have a total of 5, okay? And let's take a look at our bank account or our bank statement. How many deposits actually cleared?
4.
4. So let's take a look. So we got 360, 297, 284, and 126. So let's take a look at our deposits. Okay, did my 360 clear? Yes. We have 297. Did that clear?
Yes.
What about 284?
Yes.
And then 126?
Yes.
So therefore, what is left over?
The last one.
The last one, 483. Okay, so 483 is the only one that didn't clear. So I'm going to go ahead and write, what's the date on that? The 30th. Okay, add deposit on 8/30 for the 484. Is it 483?
83.
$483. We're going to add that back into our account. Okay. So then now that we found that one deposit, what am I going to be subtracting out from my bank account?
The checks that didn't clear.
Checks that didn't clear. So let's look at our check register. How many checks did we write?
8.
We wrote a total of 8. So let's take a look at our bank. Which ones actually cleared?
6 of them.
Only 6 out of 8. So which one did not clear? Here you can look at your discrepancies, right? Which checks numbers have not appeared. You got 301, 302, 303, 304, 305. 306 and 307 are the only two that didn't clear. Now, when you see this NSF right here, right, and you're not getting charged at all, or you're not getting it's not bounced back, therefore the bank, they wrote the check for you, but they charged you because you didn't have enough money, so they paid advance for you. Okay. So in this case, I'm missing check number 306 and 307. Now let's take a look. What amounts was check number 306 and 307?
314 and 54.
314 and 54. Okay, so going down here. 314 and 54. 314 and 54. Okay. Check number 306 and check number 307. So in grand total, how much am I subtracting out from this?
368.
368. Okay? So that's what I solved for so far. So what's my adjusted ending balance?
1203.
1203. Okay, you're going to take your 1088, you're going to add the 483 and subtract the 368 to get 1203. Now, does that mean you can stop here?
No.
No, because what if that's, okay, we do see that the answer is there, but what if there's a discrepancy? What if you end up adding on one side and they don't balance? So therefore, we need to verify that our cash side balance just as well, that we get the 1203. So in this case, let's take our cash ledger, right? What is our ending balance in my cash ledger?
1153.
1153. Okay. All right. What do I need to add to my checking account?
Any ACH and interest charges.
Okay, so ACH and interest. So let's go check it out. Do we have ACH or interest collected in our bank? Yes, we do. We have ACH and we have interest. So 125 plus 75. ACH is 125. Interest is 75. So therefore, how much in grand total do I need to add to my account?
200.
$200. Okay. All right, so then what do I need to subtract from my checking account?
Any service charges or non-sufficient fund charges?
Service charge, NSF. Since we did see that NSF, right, on our bank statement, check number 308 got charged a NSF. We didn't have enough money in the bank and they charged us. So therefore, how much did they charge us? At the very top, you have your service charges and you got charged for writing an NSF check. So in this case, 100 for services and $50 for that NSF charge. So $150. So therefore, how much am I subtracting out?
150.
150. And so let's go ahead and do the calculations, right? If we started with 1153 plus 200 minus 150,
1203.
1203. All right, and guess what? What answer that is that?
C.
C. There we go. All right. So again, this is going to be a perfect example that I expect you guys to know on the exam. I will provide like the chapter 9 and 10 review. I'll have it look like a really small short box. I'm not going to, unfortunately, Orban will not allow me to post like spreadsheets like these. So it's gonna be maybe like 3 boxes, okay? It's gonna have your bank statement, then your cash ledger, and then you have to do your reconciliation there. So it's not gonna be as super detailed as this one. It's gonna be a lot more short and more concise. So once again, exercise from chapter 9 and chapter 10, that's going to be exactly how the formatting of that question will be. Okay, you're going to get a small box that gives you your bank statement, a small box that gives you your cash ledger, and then you just have to solve for the...
Can you leave it up on the top? Yeah, right there. Put it down.
Are we going to have to look for any type of discrepancies when we do the bank reconciliation problems?
Wait, can you repeat that question again? I didn't hear the first part of your question.
I'm sorry. Are we going to have to look for any discrepancies when we do the bank reconciliation problems?
No. I want it exactly like this. I just need you to know your do's and your ifs.
How to do it? It's nice and simple.
Just because, once again, the last couple times we did the exercise, how long did it take us to locate that discrepancy?
It could take you a few minutes.
It can take you a few minutes. So again, the exam is geared towards anywhere from 2 to 4 hours. So I'm being very nice. Just understand, if you could do your do's and you can do your ifs, that's all I care about. Okay. So as we remember, like, the later chapters 7 through all the way to 11, it's a lot of packful information. There's a lot of formulas that we have to memorize. There's a lot of details that we have to memorize. So that's exactly why this exam, right, is more heavily weighted on calculations. Okay. And I'm not going to test you on super intense calculations. They're just going to be very simplified because of that reason is there's just so much information. So, all right. Nicole, are you done with this?
Yeah, you're good.
Okay.
Thank you.
All right, so next question we have here is going to be testing you on simple and compound interest. So the first example here is the simple interest, okay? All right, so you bought a bank bond worth $200,000, okay? Its simple interest is going to be 7.75%. All right, and it can be redeemable at any given time after 10 years, I believe. Okay. So, how much will the bank bond be worth in 10 years?
C.
C. All right, so let's figure this question out together. How much interest are you collecting on this problem here? So you guys, do you remember the calculation here?
Take the principal times the rate times the time to get your interest.
1,055.
Okay, just give me. Go ahead. So so that's what you got. You took the 200,000
times the rate times the time, and that gave me a total of 155. Or wait, 15,000. Wait, hold it. I can't see.
$100.
1,550. Yes. Okay.
All right.
155,000. Okay. Jeez, I made my screen bigger.
No worries. So then, therefore, what should be your future value?
C.
Yes. So you're going to add your principal to your interest to give you 35,000. So the question here is, how much will the bond be worth in 10 years? So this is asking you what the future value is. And you can't solve the future value unless you solve for the interest. So in this case, this may be a two-stepper question. So make sure that you are aware of the question that it's asking, because here I've also lodged the interest answer as well. So you need to make sure that you are paying attention and listen and reading the question carefully and know exactly what the question is asking. It's asking how much the bond will be worth in 10 years. So it's asking for future value. So in this case, the future value is indeed 355,000. Right? Excellent. Okay. And then here we have a compound interest question. So a credit card company lets you borrow $500, okay, at an interest rate of 28.9%. Okay, very typical, which is compounded every single month. How much interest will be collected at the end of 2 years?
A.
Okay, $385. Okay, so let's solve for it one at a time. So in this case, if you guys remember, you can't do this on a regular calculator. You must pull up a spreadsheet. Okay, so let me go ahead and get a quick spreadsheet real quick. Okay. So we have our principal of $500. We have our rate as 28.9%. Okay. We have our number of times compounded, which is 12, right? It's every month. And then we have the time to be set as 2 years. So first thing that I'm going to solve for is obviously our future value before we can solve for interest. So if you guys remember the formula, what's the formula?
You're going to take the principal times, and then in parentheses 1 plus, and then the rate divided by the number compounded. You put a caret, and then you'll have 12 times 2 in parentheses also.
Okay. And therefore, it should calculate it's going to cost you $885.15. And once again, how do you solve for interest?
Future value minus the principal equals interest.
Okay, so $385.15 is going to be your interest. And that's exactly what this question answers right here. So A. So here, by doing that, you need to make sure that you follow the functions carefully, especially when you're dealing with Excel. Excel is very precise, so make sure that you don't forget any of those parentheses, right? You have one parentheses in front of the one. You have another parentheses in front of the rate, and then you have to close it off with a double parentheses. Okay? If you don't, it will not let you go through, and it will give you an error message. Okay? And yes. Okay? Just like this, I'm not going to give you any complex numbers for time, okay? I'm going to have you guys just do a straightforward, easy, simplified one. So they're always going to be in years. So that's going to be A plus for you guys. Okay. So once again,
we'll be doing simple interest and not compound.
Maybe. Hold on, excuse me. Let me. Okay, sorry about that, guys. Okay, so yes, on the exam, I could test you on either or. Okay, but like I said, since you guys all have Excel, right? You guys should be able to calculate this, right? And if you don't have Excel, which I'm pretty sure you guys all do because we all took the Excel class, you guys are aware of using it. So just keep practicing that function or that formula. And you may be, like I said, you may be tested on either or simple or compound interest. Now, like what I meant was saying is that my numbers are going to be even. Like the years will be in years. The times will be in time, so you don't have to figure that part out. Okay? So no partial years, no half years, no quarter years. You're just going to get straightforward years. And like I said, I've mentioned before, right? I can ask you, do I want the interest or do I want the future value? How much interest will be collected? Or how much will it be worth at the end of X amount of years? So be a lookout for that. I may ask you a double question, right? For one specific problem, right? I may ask you, well, what is the interest for this one? And then what is the future value for this one? Okay. So I can test you on both. Okay. Any questions here? Okay. So make sure you practice your formula, especially for the compound interest one. But yes, as long as you have that and you have Excel, you should be completely fine. Okay. So that was chapter 10. Any questions in regards to anything in chapter 10? So we looked at the interest, we looked at bank reconciliation, and we got to look at receivables. Okay. All right, coming around the corner is the last section here at chapter 11. Okay, so here's a few conceptual questions here. Okay, so what fixed assets can never be depreciated? B. I will ask this question until you remember. Land. Excellent. Okay. Number 47. If fixed assets are depreciated, then intangible assets are amortized. Yes. Okay. Number 48, okay? If a machine was put into service on January 19th, when do you start depreciating it?
C.
C.
C, February 1st. Excellent. Okay, so remember, because the 19 is already past the half mark of the month. So therefore, you didn't use it for more than half a month. So in this case, you're going to assume that you're going to depreciate it starting the very first of the next month. In this case, February. Okay. Number 49, GAAP determines what two components for depreciation?
D.
D, B, and C, which is going to be the estimated useful life and the salvage value. So yes, in this case, this question asks you a completely the same exact question as the quiz, but I was specific, right? I said the two components. Now, obviously, looking at the choices, partial years is definitely not determined by GAAP at all. Okay, so here is a specific question. So yes, estimated useful life and salvage value are correct. Okay. Number 50. Okay. What are the three depreciation methods?
D.
D. Correct, right? Knowing the difference between, make sure that you know all three because they will appear on the exam. Double declining, also known as accelerated, but I'm going to give you double declining, straight line, and units of production. So yes, make sure you know all three. That's not the only three. There's more beyond that, but I'm only testing you on these three. Okay. Number 51, under the double declining method, at the end of book value must equal to
C.
salvage value, right? It cannot go beyond or it cannot go below, right? It could go above, right? And then you determine whether you want to just write it off as a loss. But for this case, it will always maintain at salvage value. Okay. It doesn't, especially for double declining, we don't care if it reaches its estimated useful life. Okay. And we already know the asset cost. It's going to depreciate. It's not going to be the same as this asset cost. Okay. All right. And so the rest of the questions are going to be dealing with the depreciation method. So this is going to be similar to what I will be asking you. Okay. So here it says, using the table below, answer the next two questions. So here I have a computer, right? Its method that we're using is straight line. Okay, so make sure that you read the box very carefully because I'll have it exactly look like this. Right? Estimated useful life, 5 years. Okay. Total amount of cost here is $2,500. All right. Salvage value is 0. And lastly, the date that we place into service is January 5th. So assuming that every year we depreciate it, right? What's going to be my depreciation basis?
2,500.
2,500. Good. What's going to be my depreciation rate?
$500.
Point
Okay.
two.
0.2. Okay, so, all right, so Felipe, you jumped ahead. So
Okay,
1
sorry.
over 5, which equals 20%. Okay. So therefore, what is now my estimated useful life? I'm sorry, what is my depreciation expense?
Felipe.
Yes. Yeah.
$500.
$500. So therefore, my accumulated depreciation for the first year
500.
is $500. And therefore, that makes my book value what?
$2,000.
$2,000. Now, of course, if you guys remember, what do we know about straight line?
Depreciation basis and the rate stay constant.
Okay, and what else stays constant?
The expense also stays the same.
Okay, so the question asks here, what is the depreciation expense for year 1 and year 2?
C.
C, $500. Okay. All right, I can ask you questions like that. I can even ask you, what is the book value out of for the asset as of year 2. Okay? So it's up to you. Make sure you read the question first so you could save a few time. So here, right, what is the book value for year 2? So let's complete our table. Okay, so what's my accumulated depreciation for the second year?
1,000.
1,000. So therefore, my total book value for year 2 is going to be
1,500.
1,500, right? You're gonna take your book value. I'm sorry, you're gonna take your asset cost of 2,500, subtract out the accumulated depreciation to get 1,500. So that answer is B. Right? So once again, I can ask any of these 2 questions here. What is the depreciation expense? And what is the book value for X year? Year X, whatever year I ask you. All right. But like I said, with these kind of questions, I'm only going to test you to the maximum of 2 years. I'm not going to let you go all the way down to 7 years if the asset is worth 7 years. So most that you get is calculating is only 2 years. And make sure that you pay attention because I could test you on partial years as well. But I'll tell you this. It's pretty straightforward. I'll make it easy for you guys. So maybe you'll get partial years, maybe not. Okay. All right. So is everyone good with the first depreciation that we just completed?
I am.
Okay. So now moving on to the next one. So for the answer, use the table to answer the next 2 questions. So this time we have a printer, and this time the method that we're using is going to be units of production. So here the asset cost is $500, the salvage value is $0, and the number of units that it could produce is 10,000 pages. And plus, we placed it into service as of January 2nd. So in this case, right, assuming that we do depreciation at the end of the year, what is going to be my depreciation basis?
500.
500, right? It's going to be your asset cost minus salvage value, which in this case, 500 minus 0 gives you 500. What's going to be my per unit cost? Or in this, my per unit rate?
0.05.
Okay, so we take my $500, right? It's depreciation basis divided by the total number of estimated units that it could produce. So in this case, right, we take our 500 and we're going to divide it by the 10,000 pages. So then that means every page that we use is going to cost me 5 cents. Okay, so therefore, what should be my depreciation expense for year 1?
125.
Okay, so we take our 5 cents, right? And we're going to multiply it with our units that we produce that year, which is the 2,500, right? And we get a total of 125, right? Therefore, depreciation, accumulated depreciation for the first year, it should be the same. So therefore, what should be my book value?
375.
375. Okay, let's go ahead and finish out the table so then we can finish up the answers. So the next one for year 2, what's the depreciation basis going to be?
Like 375.
Which method are we using?
Oh, unit produced.
Mm-hmm.
So it'll be the 500.
It'd be the 500. Okay. What about the per unit rate?
Stays same.
Stays the same. So therefore, now that I printed 2,000 pages, therefore, what's my depreciation expense going to be?
$100.
Mm-hmm. And then that makes this 225. Okay. Therefore, my book value,
It's 225.
275. I thought.
yes, yep, you're right, 275 because you're taking away $100. Okay. So therefore, let's answer the question. what is the depreciation expense for year 1?
B.
B, 125. Okay. And then what is the book value for year 2?
C.
C, 275. Okay. All right. Is everyone okay with this depreciation?
Yes.
Yes.
Okay. Last but not least, we have one last depreciation problem here. So this time we bought another computer, and this time we're not using straight line, we're using double declining. So the information's the same. You still have the asset costing at $2,500 with a salvage value of 0. Estimated useful life is 5 years, and you place it into service as of January 5th. Now, once again, we're assuming that the depreciation is done at the end of the year. So what is my depreciation basis going to be this time?
The asset cost.
It's the asset cost. So here it is 2,500. Okay. What's my depreciation rate going to be?
0.4.
Yes. 1 divided by 5 times 2, which gives you 0.4 because we're depreciating it twice as much. All right. So therefore, what's going to be my depreciation expense for year 1?
1,000.
1,000. Okay. So therefore, that makes this 1,000. So what's my book value going to be?
1,500.
1,500. Okay. Once again, let's go ahead and solve for year 2. So year 2, what's my book value now? I'm sorry, what's my depreciation basis now?
Your book value.
Your book value. Yeah, excuse me. All right. And therefore, what about my depreciation rate?
It stays the same.
It stays the same. But now, what is going to be my depreciation expense this time?
$600.
$600. Okay. Making my accumulated depreciation.
1,600.
All right. Leaving my book value to be
900.
900. All right. So let's go ahead and answer the questions here. Okay. What is the depreciation expense for year 1?
H.
H. So yeah, sorry. These things, the more that you keep adding, it keeps. This is automatic. So yes, H is the correct answer. Yes, 1,000. Okay. And of course, question number 57 says, what is the book value at the end of year 2?
H.
H. $900. Okay. So once again, any questions on how to do the units of production? I'm sorry, double declining.
Nope.
Okay.
No.
All right, so there we have it. We reached the end of our study guide. So I gave you perfect examples of what it is like to see what's on the exam. And then you can even think about this too. This is a mini exam that you just took. So by working together, right,